Karan, it is live now.
Okay, let's start. वेलकम व्यूअर्स, टीम कासा के यूट्यूब चैनल पे मैं सीए करण सिंगल आज फिर आपका वेलकम करता हूं। आप लोग हमारे साथ पिछले कई दिनों से रेगुलर अपडेट्स के लिए बने हुए हैं। हम लोग भी कोशिश कर रहे हैं कि जो भी टॉपिक्स मेंबर्स के लिए जरूरी है, जिनके मेंबर्स के पास से हमारे पास सजेशंस आते हैं, उन टॉपिक्स को हम बेस्ट वे में आपके सामने डिस्कस कर सकें। और उसी सीरीज में आज हम जो टॉपिक डिस्कस करने आए हैं, इनकम टैक्स से रिलेटेड टॉपिक, जैसा कि आप सबने देखा होगा, डीम्ड इनकम तो आप सभी जानते ही हैं, बट डीम्ड इनकम ने एसएससी को डूम कर रखा है। तो इसलिए आज के हमारे टॉपिक का भी नाम है डीम्ड इनकम डूम्ड। तो इस टॉपिक को डिस्कस करने के लिए आज हमारे पास जो स्पीकर हैं, अवर टुडे स्पीकर भी हमारे साथ जुड़ चुके हैं, सीए डॉक्टर राकेश गुप्ता जी एंड सीए सोमिल अग्रवाल जी, बोथ आर दी पार्टनर्स। मैं अपने को होस्ट सीए सुमित गर्ग से रिक्वेस्ट करूंगा कि वो आज के स्पीकर्स का इंट्रोडक्शन दें और आज के सेशन को स्टार्ट करने। सुमित जी।
Thank you, Karanji, for taking initiative and starting the program. First of all, welcome Rakesh sir for your wonderful presence, and Somil ji, welcome to you. First time you are here in this CASA platform, so welcome to both of you, sir. And today's topic, very important topic, as
क्या हुआ?
just a minute, sir. It is repeating. I think some. Sir, it is clear, Karan? Voice is clear?
Yes, yes.
Okay, perfect. So before welcome and invite.
Please carry on. It's all right.
My repeat sound is coming.
Yes, yes, it is
वॉइस
coming.
क्लियर है, आप बीच में स्टॉप हो रहे हैं, वॉइस क्लियर है।
Okay. So before inviting our speaker of the day on this important topic, deemed income, doomed assessee, I would like to brief about both of the speakers before inviting him. First, I would like to welcome Dr. Rakesh Gupta once again, and although he does not need any introduction, still for the benefit of the all members at large, I would like to brief about him. He is high school and intermediate secured merit position and graduation from St. John's College, Agra in 1980, and secured first rank in university, FCA, FCS, ICWA, MBA, LLB first rank in university, LLM, PhD, and he was appointed as a member of Income Tax Appellate Tribunal at the age of 37 only, and posted at Hyderabad, but resigned later on to serve the profession. And he's co-authored of the with the partner Dr. Rajkumar Agarwal. Two books he has authored. One is Search and Seizure and Assessment of Search Cases, and second one is Taxation on Real Estate Developers and Joint Development Agreements. He is practicing as an advocate and appearing in Income Tax Appellate Tribunal, High Courts, Supreme Courts, and argued many cases, many high-profile cases throughout country. He has participated in United Nations Committee of Expert on International Cooperation in Tax Matters. He has held at UN headquarters in New York in April 2017 and April 2019, and at European Union headquarters at Geneva in October 2018. So, sir is having a vast profile, and I think everyone knows about him. So, before proceeding further, I would also like to brief about young and dynamic speaker CA Somil Agarwal ji. He is also having degrees CA, CS, CMA, DISA diploma, LLB, LLM from UK. And after qualifying his practicing as an advocate. He has argued several direct tax cases having wide ramification before the various benches of ITAT and other appellate authority, and several cases argued by him have been resorted in the leading tax journal. His partner in RRA Tax India in Delhi, leading professional law firm and having rich experience and rendering tax advisory representation service to the listed and private corporations. And many more experience he is having. He has delivered many webinars, seminars. So welcome to you, Somilji, once again.
Thank you, Somil.
And to all my viewers, first of all, I would like to welcome to each one of you on this eve of CA Day. Tomorrow is CA Day. So once again, I wish to everyone on this eve of CA Day. So proceeding further, I request Dr. Rakesh Gupta ji to give overview on the topic so that we can proceed further. Over to you, sir.
Thank you. Thank you, Sumit ji, Karan ji, my fellow co-speaker, young, dynamic, brilliant chartered accountant, lawyer, CA Somil Agarwal. Thank you for having invited both of us to discuss our thoughts on a topic, deemed income. And along with the deemed income, the topic contains the doomed assessees. And therefore, it has evoked enough amount of curiosity and interest as to what is the correlation between the two. Now, when Somil will traverse through the various sections under which certain receipts which do not have even the trace of any income whatsoever are treated as income, and that too the taxable income, then one can appreciate the plight of an assessee. Therefore, when such kind of artificial taxation is fastened at the door of the taxpayer, then there is no option for the assessee to be doomed. And that is why, in respect of such kind of artificial taxation system, this expression of doomed assessee has come to be used. So first of all, I will request Somil to take you through the various sections under the Income Tax Act, right from the gate where the income term has come to be defined across the entire Income Tax Act, to show that as to what is the nature of such income which does not have any character of income and yet they are made taxable. So Somil, first of all, you take 25-30 minutes and then I will pick up the thread.
Thank you so much, sir. My guru, Dr. Rakesh Gupta, sir, Sumit ji, Karan ji. So as sir has already given the overview, so I would be taking through the various provisions. I'll just share my screen. Sumit ji, is it visible?
Yes, Somilji, yes.
Yes. So as mentioned, deemed incomes. In fact, there are certain provisions where, despite the transaction is not in the nature of income, the receipt is not in the nature of income, however, still it has been on the basis of the provisions which have been brought in the statute, have been given the color of an income and accordingly been brought to tax. So the first section which comes to my mind on this, where the receipt is not in the nature of income, however, it is still being treated as a taxable income, is section 222 subsect clause E. Now, deemed dividend is the word coined for it, section 222E, which defines dividend, and clause E provides that where any company, not being a company in which public are substantially interested, makes a payment by way of advance or loan to a shareholder, a beneficial owner of shares, holding not less than 10% of the voting power, or any payment by way of advance or loan made to any concern in which such shareholder is a member or partner, or and in which he has a substantial share, or any payment by the company, by the closely held company, on behalf of or in the individual benefit of such shareholder would be treated as deemed income, deemed dividend, to the extent of the accumulated profits available in the company. Now, sir, you may kindly recall, there used to be a lot of litigation whether this amount would be taxed in the hands of the shareholder or in the hands of the company. Initially, it was being taxed in the hands of company. Then Honorable Delhi High Court and Anki-Tech in various judgments came that no, this would be taxed in the hand of the registered shareholder, and accordingly, and this proposition has also been upheld by Honorable Supreme Court in the case of Maduram Housing, wherein it has been held that this would be taxed in the hand of the shareholder. So a shareholder who is receiving an amount as an advance or a loan, this amount is being deemed, and the complete nature of this amount in the hands of this receipt in the hands of the shareholder is being changed. It has been given the color of a deemed dividend in the hands of the shareholder and being brought to tax. On various, there are number of facets which sir will take in a later part, various issues. The second provision, 224 subclause 10. Now, recently the whole fiasco which we all as councils, tax consultants, chartered accountants are dealing, that in the 143(1) processing of the returns, the employee's contribution to EICWA, if delayed, if paid in a delayed manner, then it is being adjusted in the 143(1) adjustments. So the provision 224(10), 224 defines the word income for the purpose of Income Tax Act. So clause 10 of this provision provides that any sum which is received by the assessee from his employees as contribution to any provident fund or superannuation fund or any fund set up by ASI Act, then that amount would be treated as income in the hands of the assessee employer. Now, sir, very strange concept that an assessee employer who is acting as a conduit, who is acting as merely an agent, who is getting the contribution from the employees and is paying to the respective fund under the required act. Now, this amount, this receipt in his hand is only as a conduit in his hand, as a recipient, is being treated as income. And although, yes, this amount once received is treated as income, and accordingly, if paid within the due date as prescribed under section 36(1) clause 5A, in the explanation to that section, if paid within the due date up to the date of as provided under the EICWA Act, if the amount is paid, accordingly deduction is allowed. But the question I am raising here is, why such kind of a receipt, which is not even the income for the employer assessee, is being treated as income? So this is 224(10), where again receipt not in the nature of income is being treated as a taxable income under 224(10). Section 224(11). This section treats any amount received on account of a keyman insurance policy, including the sum by way of a bonus on such policy, is being treated as income. Now, an amount which is being received on account of an insurance policy or a bonus on that policy is not in the nature of income per se, but by 224(11), such amount being received has been included in the definition of income. Keyman insurance policy has been defined in explanation to 1010D. It is basically a life insurance policy for a person who is a key person for the business of the assessee. 224(12). Now, this refers that the sum which is referred under section 28 clause 5A would be included in the definition of income. Now, what is this clause 5A of section 28? Section 28, you may kindly recall, it is charging section for income under the head business and profession. So 28(5A), clause 5A, it provides that any sum received or receivable in cash or kind under any agreement may be oral or writing, under any agreement, for not carrying out any business in relation, not carrying out any activity in relation to any business or profession, or not sharing any know-how, patent, copyright, trademark, etc., likely to assist in the manufacturing or processing of goods or services. So basically, a non-compete fee received by any person is taxable under the head business and profession under section 28 clause 5A. Now, I ask a question to myself. Now, this is an amount received on account of non-compete fee, which hits directly to the source of a person, the capacity to earn an income, and something which hits the source of a person, in my humble submission, should be treated as a capital receipt. However, by virtue of Section 228(5)(a), it has now been treated as revenue income, income under the head business and profession under Clause 5A of Section 28. So, next is Section 224, Clause 17. Again, another clause in the definition of income, which refers to the amount, sum of money which has been referred in Clause 9 of subsection 2 of 56. Now, 56 is a charging section under the head income from other sources. Now, income from other sources, subsection 2, Clause 9, which was inserted by Finance Act 14 with effect from 1st April 2015, it provides that where any sum of money is received as an advance or otherwise in course of negotiation for transfer of a capital asset, if and such amount would be treated as income from other sources if such sum is forfeited and the negotiation do not result in transfer of capital asset. So during the course of negotiation for a capital asset, if an assessee receives any advance or otherwise any sum in the course of this negotiation for transfer of capital asset, during the process of transfer of capital asset, and if the negotiation or the dealings, the transaction does not mature, the transaction does not result in transfer of the capital asset, and if this sum which has been received in advance is forfeited, then this is treated as income under the head income from other sources under Clause 9 of subsection 2 of Section 56. Again, the assessee is receiving amount in respect of a capital asset, and this is an advance which is forfeited, which earlier used to go to reduce the cost of the asset. In fact, in future, when that asset would be sold, derogates this provision which has been brought on the statute. Earlier, that amount which was forfeited used to be reduced from the cost of the asset while the asset was being sold. However, now the legislature has brought that as soon as the amount is forfeited and the negotiations have failed, the transfer of asset has not taken place, then and there the amount received as an advance would be treated as income under the head other sources. Section 56(2)(7)(b). Now, a closely held company in which public are not being a company in which public is substantially interested, if such company receives from any person being a resident any consideration for issue of shares that exceeds the face value of such shares. So we understand it as the share premium. Share premium received by a closely held company in respect of issue of shares, if it exceeds the fair market value, if the aggregate consideration exceeds the fair market value, then such excess would be brought to tax under Section 56(2)(7)(b). Now, again, this company is receiving this amount on account of shares being issued, on account of the share premium, on account of the valuation of the shares of the company and the share premium which it is commanding in the market on the basis of obviously proposals and whatever investments the company has made. So this amount which is being received is merely for the issue of shares of the company. However, this provision deems that where the share premium is more than the fair market value of the share premium and the face value aggregate is more than the fair market value of the shares, then such excess would be brought to tax under Section 56(2)(7)(b) as deemed income of the company. Now 56(2)(10). 56(2)(10), a recent provision in the statute, subclause A, where any sum of money which is received without consideration from any person or persons, the aggregate value of which exceeds 50,000, then the whole amount of this aggregate sum is sought to be taxed under Section 56(2)(10)(a). So transactions in the nature of gift, obviously not from persons who are excluded like relatives and etc., but transactions which are in the nature of genuine gifts received from persons, if it exceeds 50,000, since it is a transaction without consideration, then the whole of the aggregate value of the sum would be taxed under Section 56(2)(10). Now, sir, till here we were discussing the receipts which are received, which are not in the nature of income, still by virtue of the various provisions, they have been given the color, they have been artificially, they have been brought to tax under the provisions of the income tax. Section 68 to 69D are such provisions where 68 we know that amount which is credited, which may not be in the nature of income, still if the ingredients of section 68 are not fulfilled, would be deemed as income. To these sections, we'll come to it a little later. Meanwhile, I'll proceed to that area, those provisions where, in fact, till now we were dealing where there was actual receipt. However, the sum received was not in the nature of income, but was treated as income. Now, I'll put forth the provisions where even received, I have not received, this SE has not received the amount, still the amount, the transaction, the amount, the transaction is treated as income in the hands of the assessee. Now, the first provision is section 224(12)(a). 224 again, the definition of income, where clause 12(a) provides that the fair market value of inventory referred to in clause 6(a) of section 28 is included in the definition of income. Now, what is clause 6(a) of section 28? Now, sir, clause 6(a) of section 28, this provides that in case of conversion of an inventory to capital asset, the fair market value of the inventory as on the date on which it is converted to or treated as a capital asset would be charged to income tax under the head business and profession. Now, a very strange thing, inventory which I have converted into capital, right now I have not sold it, I have not received any sum against it, on mere conversion has taken place, and it is being charged to tax. There is no actual receipt, and still I am being made to pay taxes on it. So this is a very, and I would say a perfect example to say that the assessee would be doomed in such situations, that there is no receipt, merely conversion through a capital asset, and you are required to pay taxes on it. The fair market value of the inventory would be computed. The prescribed manner is given under Rule 11 UAB, which provides for 3 different scenarios. In case of immovable property, it provides for stamp duty valuation. And in case of properties like archaeological jewelry, which have been given valuation method under Rule 11 UA, that would be valued as per 11 UA. And any other property which is not covered under the first 2 clauses would be valued as the amount which it would fetch in the open market on the date of conversion into capital asset. So all these valuations would be made on the date on which the inventory is converted or treated as capital asset. So section 50C. Now section 50C, one of the section which has provided that where in respect of land, building, or both, the consideration received or accrued as a result of transfer is less than the stamp duty value for the which is valued for the purpose of such transfer, then the stamp duty value will be deemed to be the full value of consideration for the purpose of this transfer. Now again here, an assessee who has sold a property and has received some consideration which is less than the stamp duty value, then the stamp duty value is replaced as the deemed value of consideration. Again, the amount, the difference between the stamp duty value and the actual consideration which the assessee has not received is being brought to tax under section 50 capital C. Although there is a provision which has been provided that if the difference between the stamp duty value does not exceed the consideration, or I can say the stamp duty value does not exceed 105% of the consideration actually received or actually accrued, then the consideration so received or accrued would be the deemed full value of consideration. That margin of 5%, that float of 5% is there. However, this section seeks to tax that part of the income which actually the assessee has not received and is even not going to receive. He's never going to receive it, but still on the basis of assumption that yes, oh, you must have received consideration equal to the deemed the stamp duty value, we will tax you at the stamp duty value, despite the assessee has not received such kind of consideration. So the difference between the stamp duty value and the actual consideration has been brought to tax despite there is no actual receipt of money. Similarly, section 43 CA. Now, section 43 CA is applicable in case of assets, land or building or both, which are other than capital asset. And again, the same concept, that where the consideration received or accrued to on result of the transfer is less than the stamp duty value, then the stamp duty value would be deemed to be the full value of consideration. Again, the similar concept of 5% float is available, that if the stamp duty value does not exceed 105% of the consideration received or accruing, then the consideration so received would be treated as the treated as the full
Somil,
value of consideration.
Finance Act 2020 has made it 10%, 110%. Okay.
Okay, sir. So Finance Act 2020, as sir has said, the float has been now brought to 10%. Still, the point I want to highlight is this, that the difference between the stamp duty value and the actual consideration, which the assessee has not received and is not going to receive, is being sought to tax as a deemed income on under section 50C in case of capital assets and section 43CA in case of revenue assets. Section 50 capital CA, where the consideration, it is applicable in case of shares other than quoted shares, where the consideration received or accrued other than received or accrued in case of shares being share of a company other than the quoted shares is less than the fair market value as determined under Rule 11 UA, then for the purpose of section 48, the full value of consideration would be the fair value so determined. And accordingly, again, the same difference between the deemed full value and the actual consideration which has been received, which has not been received by the assessee, is being brought to tax under section 50 CA. Section 56 to 10. We discussed clause A in the earlier scenario, where even though the amount is received, but it is received in the different nature, it is being brought to tax and it is being given the color of income. Whereas in 56 to 10, in clause B and C, what is received is property. Clause B we'll discuss first. In case of immovable property, without consideration, the stamp duty of which exceeds 50,000 rupees, then the whole stamp duty value of such property would be treated as income under clause B of clause 10 of section 56(2). In case this immovable property is received for a consideration, but the consideration is less than the stamp duty value, then the excess of the stamp duty value from such consideration would be brought to tax under section 56 to 10. Obviously, subject to the two limits, that amount of 50,000 rupees or amount equal to 10% of consideration, whichever is higher. Clause C, in case of property other than immovable property, where the consideration either is not where the immovable property either is received without consideration, then the aggregate fair market value of such property which exceeds 50,000 rupees, then the whole of this aggregate fair market value is brought to tax under this clause. And in clause B, where the property other than immovable property is received for a consideration, but the consideration is less than the aggregate fair market value by an amount exceeding 50,000 rupees, then such excess of the aggregate fair market value as it exceeds the consideration received would be brought to tax under this clause. So in all these scenarios, the amount, the deemed consideration, the stamp duty value which is being taken, or the fair market value which has been taken as a deemed consideration, the difference between such stamp duty value or fair market value and the actual consideration which is not received, which will not be received, is being brought to tax under section 56 to 10. So, sir, two category of provisions we discussed, where one was that income, the amount has been received, but it is not in the nature of income. The other one, where is no amount has been received, but it is being brought to tax as income. Now here, I want to discuss one provision where it is a provision which provides, which is in respect of expense, wherein a technical violation would treat such amount as income. Now, what does this provide? 40A3A. This provides that where an allowance in respect of any liability has been made in any assessment year, and in any subsequent year, assessee makes payment, otherwise than by account pay check, account pay bank draft, or electronic modes, the payment so made to a person in a day exceeding 10,000 shall be deemed to be the profit and gains of business or profession. So an amount which was incurred in respect of an expense in an assessment year, which has been allowed as an allowance on mercantile basis, and in subsequent year, if assessee makes payment in cash exceeding rupees 10,000 to a person in a day, then such amount would be deemed to be income as profit and gains of business or profession in the subsequent year in which the payment is made. So obviously there are exceptions to it in the rule 6DD, but again in this scenario this is a situation where expenses are being deemed to be income under the head profit and gains from business or profession. So with this, these are the various provisions in different scenarios which I wanted to discuss. And with this, I hand over to Gupta sir to take the proceedings forward.
Thank you, Somil. The topic which is fixed for today is deemed income. Now, these deeming fictions, they are really very frightening. And our Income Tax Act is replete with such kind of deeming fictions. You name it and it is there. It is there at the drop of the hat. And I always say deeming fictions catch you from the back. They catch you when you are found asleep. You are taken unaware. And then when you are caught, then there are very few occasions when then you can retrace your steps back. Then you have to encounter that kind of a situation, and then ultimately you may end up in paying tax. So I will take few of these deeming fictions, the consequences, the issues and the nuances which are embedded into these deeming fictions. Now, the definition of income, therefore we cannot technically say it's a deemed income. When something is defined to be included in income under the Income Tax Act under section 2 subsection 24, or for that matter under any clauses of section 2, then we cannot say it is a deemed income. It is income. But then what do we mean by deemed income is that these so-called incomes, which are called as income, they at times do not have any trace of income, and yet they are not only treated as income, but then they are taxed as income. And the first thing this category of income which I want to deal is the income by way of dividend under section 2 subsection 22 clause E. Now this clause is not very comprehensively worded, but then whatever has been worded, each word of it has got its meaning, has been tested before the courts. If not tested so far, is prone to be tested before the court. Now, dividend includes, that is what section 10, that is what section 2 clause 22 says. Dividend includes, and the clause he says, payment of any sum made by a company in which public is not substantially interested to a person holding not less than 10% voting power, or to any concern in which such shareholder has got substantial stake, substantial shareholding, or substantial benefits. Then to the extent of the accumulated profits of this company, which is the lending company, the closely held company, a company in which public is not substantially interested, then such amount will be treated as dividend. You kindly see the height of fiction, that an amount by way of loan or advance given by a closely held company to a shareholder or to any concern in which he has got substantial stakes and holding and interest, now to the extent of the accumulated profits of this company will be treated as dividend. But then there is a sovereign. The sovereign can deem anything for anything. And when its constitutionality comes to be challenged and it is sought to be conveyed before the court that, my lords, this fiction has been created to thwart the attempt on the part of overindulgent assessees who do not want to pay dividend distribution tax, but at the same time they ensure that the money goes to the shareholder. And therefore, this is nothing but an indirect way to transfer the money to the shareholder, which otherwise would have been transferred to them in any case as dividend. So in that situation, even the courts are constant to consider, oh, this is a very noble, it will serve very noble purpose. It seeks to put a plug on an attempted tax avoidance, and therefore, even if it defies logic, it defies the common sense, but then the courts say we are constant to uphold the constitutional validity. The same thing happened with this kind of provision when under 1922 Act, Section 2, Clause 6, capital A, which is in perimeteria of Section 222E of 1961 Act, was challenged before the court on the constitutional touchstone. Their lordships refused to show any indulgence and then upheld its validity. But then now kindly see the payment of a sum by a company in which public is not substantially interested. A company in which public is substantially interested has been defined under Section 2, Clause 18 of the Income Tax Act. So any company which does not fall into the definition of that company in which public is substantially interested obviously would mean this is the company in which public is not substantially interested. But then not all companies, of course it should not be private limited company, but then there may be limited company in which public is not substantially interested ostensibly. But in certain situations, such kind of limited companies, even if it is closely held, in certain situations, it may still be called a company in which public is substantially interested. Therefore, one should not go merely by this fact that this company is closely held. Therefore, in all facts and circumstances, this company will be a company in which public is not substantially interested. No. If you read the clauses, the sub-clauses of Section 2, Clause 18, then you will find in certain situations where this company, which is closely held company, but certainly it is not a private limited company, when is subsidiary of a company in which public is substantially interested, then this also becomes a company in which public is substantially interested, even if the shareholdings are limited to certain specified number of individuals. There may well be a situation then the aggregate of the shareholding of such companies who are holding shares in this company, if they are aggregated and all those companies are the companies in which public are substantially interested, then also this company, of course limited company, having closed number of shareholders, then would become a company in which public is substantially interested. So this aspect needs to be taken care of while seeing the applicability of Section 222E. Then any payment of a sum, any payment by a company, payment of a sum by a company, there has to be the cash outflow. That is one view. There is another view also, that even if there is a debit on account of the supply of goods, and that supply of goods ultimately can partake the character of loan or advance, but then there is another view also that there has to be the outflow of money. Only then Section 2, Clause 22, subclause E can be hit. And for that I remember 105 ITD page 558 is the decision, and which has considered even the Calcutta High Court decision in the case of MD Jindal, which used to say something else, 164 ITR 28, 164 ITR 28. So payment of a sum by a company, now that phrase is very important. and therefore you can test it in appropriate cases where the debit has arisen as a result of passing the journal entries. The courts have said that passing a debit by way of journal entry may not lead or cannot be termed to be as payment, and therefore section 2 subsection section 2 clause 22 subclause E may not be attracted. The second facet is a company in which public is not substantially interested. That phrase also needs to be examined closely on the touchstone of section 2 clause 18 of the Income Tax Act in order to find whether this company can be said to be a company at all in which public is not substantially interested, or because of the fictions which is there under section 2 clause 18, this company would become, despite ostensibly it is a closely held company, but nonetheless it would become a company in which public is substantially interested. Then payment of a sum by a company in which public is not substantially interested by way of loan or advance. This is very important phrase. Not any or every payment is envisaged to be covered under section 2 clause 22 subclause E. That payment must be payment on account of loan or advance. Even that advance has to be in the nature of loan. After all, the word loan would or the word advance would take the color from the preceding expression. The rule of adjusdem generis, the rule of nociter socis, that a meaning of a word has to be given based upon the meaning of the word under and whose company this word is. A man is known by the company he keeps. Similarly, the meaning of the words in law at times have to be interpreted in the light of the meaning of the words in whose company this word is placed. So loan or advance. So if the amount has been given by way of an imprest to meet certain expenses, and it is a genuine imprest, then even if it is an advance, even if it would entail the debit, but then the courts have said this imprest advance is not in the nature of loan. But then, as all of us know, that the real and substantive nature of the transaction holds the key. Now, if you give a color of a loan into an imprest advance, then of course assessing officer, being a quasi-judicial authority, is entitled to go deeper into the nature of the transactions and then determine the true character, and that is his job, that is his duty. So if based upon that analysis the assessing officer comes to a conclusion that apparent is not real, there is something more than meets eyes, and therefore the real character is not of imprest advance, but the real character is the loan or advance being shown and camouflaged in the nature of imprest advance. So that aspect has to be borne in mind. But then of course the advance is given to such shareholder or to his concerns in the ordinary course of the business. Now that will not be that is not sought to be, or that is not intended to be covered within the sweep of section 2 clause 22 subclause E. But then you will have to prove it. It is a matter of fact. But then mere saying that it has been given as a trade advance, I mean, it would not suffice. If something on facts you say, and unless you substantiate with evidence, this is nothing but dropping the water on this is nothing but dropping of the water in sand, on sand, and therefore it will dissipate, it will disappear, and it will have no meaning. So trade advance, yes, if on facts you are able to prove this is trade advance, then of course it will not be, and there are decisions to this effect. I need not to go into it. But then loan, I mean, though it is a Chennai bench decision, and that is the solitary decision I could lay hands. Now, which says that if the holding company is receiving loan from the subsidiary company, if the holding company is receiving the loan from the subsidiary company, even that is not intended to be covered under section 2 clause 22 subclause E. Now 51 SOT 452, the court has taken this view. This view is not final. It needs to be proved as to whether there are any other decisions to this effect. But then recently, the Delhi bench of the tribunal, only a decision which has been pronounced on 29th of June. Now, I said that transactions, frequent transactions in the nature of current account transactions between two companies are also not intended to be covered under section 2, clause 22, subclause E, because these transactions are so frequent in the current account that they defy the meaning of the words loan or advance. Again, much can be debated on it, but then Delhi bench of the tribunal has taken help of the precedents which were available and one decision of the Punjab and Haryana High Court also, and which is reported in Sunita Dada 364 ITR, that has been cited there. One Mumbai bench decision, one Kolkata bench decision. So the purpose is that since this fiction catches you from the back, and therefore what are all facets of it that you must be aware of it, so that when you are confronted with this kind of a situation, then you can put up your defense. Then payment by a company, which is a company in which public is not substantially interested, by way of loan or advance to a shareholder, holding not less than 10% voting part, holding shares holding shares with not less than 10% of the voting power. The voting power obviously is ascribed to the equity shareholders. So 10% voting power, if that person is not the shareholder to whom the loan has been given, or to a concern in which he holds substantial stake. So even if the loan has been given, or advance has been given to those concerns in which this shareholder has got substantial interest, then also, because the dividend can be taxed in the hands of the shareholder, though the board's stand in circular 495 is that it will be taxed as dividend in the hands of the shareholder. In fact, I had an occasion to argue matter along with other, because it was a batch matter in Ankit Act 340 ITR at page 40 before the Delhi High Court, where the question arose that if the amount of loan has been received by a concern, that concern is not the shareholder in this company, the lending company, but the shareholder of that lending company holding more than 10% shareholding is having more than 20% stakes in this concern. Now, whether loan or advance to that concern, if at all it is treated as dividend, but then it will be taxed in whose hands? The Delhi High Court, but now it has been approved by the Supreme Court also, as Somil has pointed out in Madhur Housing 401 ITR 152. But in yet another decision, this is yet to attain finality, though the two judges bench in Madhur Housing and Development Company have held in this favor that a person has to be shareholder, only then the amount can be brought to tax, because it is dividend, and the dividend, as the term suggests, has got direct, proximate, inextricable link with the shareholding of a person, and therefore it is the shareholder alone who needs to be taxed. But Supreme Court, by a bench of an equal strength in National Travel Agency 401 ITR at page 154, had got certain reservations from this proposition of law, and therefore they could not have sit over that decision which has been passed by a bench of an equal strength. Therefore, they have referred this matter before the larger bench. But then, of course, even today, the decision and the ratio of Madhur Housing and Development, I mean, that holds the field, because the operation of that Supreme Court decision has not been stayed, or has not been stayed. But then when says such shareholder holding not less than 10%, or not holding not less than shareholding having voting less than 10%. So 10% of whom? The 10% of this person to whom either the loan has been given, or a concern in which this shareholder has got more than 20%. So if there are, say, suppose two shareholders, and having 8% each, and they may be husband and wife, they may be a man and his son, all that has to be seen for the purpose of applicability of section 2 clause 22 and subclause E is that individual shareholding will have to be seen. There is no concept of aggregating the shareholding, even if the shareholders are very closely related to each other. And in one of the judicial decisions, the court has gone even to this extent that even the shareholding held in the name of the minor with respect to the voting power is to be exercised by his father, and along with this minor's son shareholding and the father's shareholding, it exceeds 10%, but then individually it doesn't exceed 10%. Then also the courts have said that for the purpose of determining whether a person is having more than 10% voting, the both have to be aggregated. Court said no. So this aspect also needs to be taken care of. And very important proposition is that this loan or advance should not be part of the lending business of the lending company, where the lending is the dominant segment of the business of the lending company. So if some exception is sought to be claimed on this ground, that this lending has been given in the ordinary course of a lending business, but then it will have to be demonstrated that the lending is substantial part of the overall business of the lending company. Now, substantial has not been defined for this purpose. Therefore, several factors have to be taken into account as to what is the composition of total income, whether on that basis, if the substantial income, which is part of the total business income, is coming from the lending business, that can be one factor. The majority of the funds deployed for the purpose of lending now is out of the total funds, that would indicate. So it is the several factors put together would prove whether the lending is substantial part of the business. Now, many times my chartered accountant friends say, sir, this amount has been given on this amount, though has been given by way of a loan, but then it bears interest, and therefore the interest is coming. That is inconsequential. Many times my chartered accountant's friends say, sir, the loan was given, the next moment it was taken back. Then also for the purpose of section 2 clause 22 subclause E, it is immaterial. The moment there is loan or advance, even for a day, even for an hour, even for a moment, and the other moment then you have taken it back, it is like crossing the Lakshman Rekha. You have crossed the Lakshman Rekha, then you have crossed it. Even if you take your steps back, then you will have to take the hit. That is the beauty of this section 2 clause 22 and subclause E. And the ferociousness of this provision is of this magnitude, and that is why I am constant to say deemed income and the doomed assessee. Now, if a shareholder is having 12% shareholding, and this company grants him the loan, now in what manner he is in a position to influence the decision of that company? He does not have majority interest. 12% doesn't make him to take decision. But then 10% threshold, which has been kept in this section, is absolute threshold with no variation or latitude or leverage given. Now, to the extent to which this company possesses the accumulated profit, if there are no accumulated profits, then a closely held company can grant any amount of loan to its shareholder holding more than 10% stakes without any consequence under this clause to come. Yes, there may be other consequence, that if the borrowed funds have been diverted, then the interest in relation to the borrowed fund now is liable to be disallowed under section 36(1)(3) on the ground that the borrowed funds have not been used for the purpose of business. But then if this company does not have accumulated profits, as on the date when the loan or advance was given, the position has to be seen on day-to-day basis. So if on the date of granting of loan or advance, there were no accumulated profit of the company, then no amount of loan can be treated as dividend. Even if after the date, say on 15th June, the amount was given, there are no accumulated profit on 15th June. But on 20th June, some capital asset is sold, substantial amount of capital gain comes, and therefore the reserves swell and accumulated profits become. Then also, because position has to be seen, position of the accumulated profits will have to be seen as on the date of the grant of loan. And then once an amount has been treated as dividend because of this reason, then the accumulated profits have to be reduced notionally. And associated with this, there is one very important thing which I am going to share and which I have tested number of times. And that is that if similar amounts of loan or advance to such kind of shareholders or their concerns have been given in past, maybe in earlier years, though these loans or advance given in earlier years to such kind of persons have not been treated as dividend in their hands because of the inaction, negligence, omission or commission by the tax authorities, or because of the assessments having been made under section 143(1), or the assessments though having been made under section 143(3), but then those amounts were not taxed or were not treated as dividend under section 2 clause 22 subclause E. But then for the purpose of determining the accumulated profits in this year, all those amounts which were in the nature of deemed dividend under section 222E, though they were not taxed in those years, yet for the purpose of determining the accumulated profits in current year, when we are examining the availability of the accumulated profits on a particular date in current year, all those dividend, all those deemed dividend, though they have not been taxed, but the fact they were the loans, accumulated profits were there, the parties were the shareholders holding more than 10% shareholding, those loans will have to be reduced notionally. Now, if at all the department has got time with it, then can go back and then reopen the assessments of those individuals by observing the process which is known to law, that is by recording reason, having reason to believe that the income chargeable to tax has escaped assessment in the hands of the shareholder, so on and so forth. But I am driving one very important proposition of law, that in order to determine accumulated profits today, when I'm examining the availability of accumulated profits, if there were loans or advances given to such parties in earlier years, and even if they have not been brought to tax and accumulated profits were there, of course, or had assessing officer at that point of time applied section 222E in respect of those loans and advances, then they would have been treated as deemed dividend. So once they would have been treated as deemed dividend, they would always be treated as deemed dividend whether they have been brought to tax in the hands of the shareholder. So for the purpose of determining accumulated profits today, we will have to notionally reduce. And I have experimented it. I have been successful in litigations. I had done working from those years. Sir, at least you remove from here. If it is removed from here, then we will see when appropriate time would come in those years when the department takes up the action. 11 ITD 158 is the first judicial decision to this effect. 11 ITD 158. Cochin bench. Gordon Das Khimji. Now, the real deemed incomes, which is often understood, they are under section 68 to 69. They were relevant and important for all times. But then after the introduction of section 115 BBE, such incomes have assumed the special importance. And more particularly, post demonetization, the assessments which have been made, and section 115 BBE having been made to undergo a drastic change in terms of the tax rate from 30 to 60%, and effective tax rate comes to 78%. 60% tax, 15% surcharge, and 3% the cess. Aggregate 78%. And then there is a penalty in certain situations under section 271 AAC to the extent of 6%. So with a stepped up tax rate of 115 BBE, these sections, though were relevant and important for all times in the past gone by, but then it has assumed more importance after the introduction of section 115 BBE, more so after the introduction of the stepped up tax rate under section 115 BBE. So we will discuss about these sections, though you are all aware. I am conscious that I am speaking before the august gathering of the illustrious professionals. I need not to take you through the provisions of this law. One of my friends, I was watching YouTube, his name was Sanjay ji. He said that I should speak macro. I cannot speak macro on the taxation philosophy. If at all such incomes ought to be taxed on notional basis or fictional basis or not, even that can also be discussed. But then even out of this micro aspects, I would touch upon certain macro aspect, and maybe my friend Sanjay ji may feel about that macro taxability of the issue. So section 68, any sum found credited. Any sum with no boundary, with no restrictions, which many times we tend to read. Many times, and there may be judicial decisions, but I am not on judicial decisions. Because after all, those judicial decisions are subject to judicial review before the higher, unless the final word comes from the final court. Any sum found credited, even if that sum is represented or sum is on account of the sales. Somebody can say, and people say, Rakesh ji, when we ourselves have offered some amount of income to the creditor profit and loss account, now what the assessing officer would do ultimately, and therefore income would nonetheless remain as income. Therefore section 68 should not be made applicable on them. With utmost respect, with utmost humility and humbleness, I would say, even you go by the rule of literal construction, or even if you go by the rule of purposive construction, in both the situation, the restrictive meaning cannot be ascribed, cannot be attributed, cannot be given to this phrase, any sum found credited. Now, do you want to say that if I have shown something as income, therefore the assessing officer is precluded from determining its true nature and true nature of this income? I would say I would feel sorry if your interpretation is like this. Maybe I may have shown it as income, but then in facts and circumstances, this not, though it may be income in the larger sense, but then it is not the income, the kind of income which you have sought to show. You have shown it as income from a business, whereas that income is though income, but this is not an income by way of sale from the business. Now, would it not, if the assessing officer determines the true character of this income, that this is not the sale as shown by you, and therefore it is of different genre, different color, different texture, because the moment the character of that income undergoes a change, there is overall change in the entire complexion of the taxability. You offered that amount under the head business, but then if the assessing officer has determined the true character of this credit, sir, this is not a credit from your business, this is a credit for something else. Assessee has not been able to explain the nature and the source of this credit. Now, immediately the taxability would shift from section 28 to section 68. had this income remained under section 28, it would have suffered the tax rate of 30%. The moment this income came under section 68, the tax rate would shoot up to 78%. And now you want to say in the backdrop of this that the assessing officer is precluded from determining its true nature merely for the reason that I myself have offered the income to the credit of my profit loss account? I'm sorry. So if you go by the rule of literal construction, any sum found credited, literally any sum which is found credited has to be gone, is entitled to be gone by the assessing officer. Rather, he owes a duty. A duty is cast on him in law. And even if you go by the purposive construction is to determine the true character of that income. Apparent is not real. Apparent may not be real. Any sum found credited in the books of account of an assessee. Of course, existence of the books of account is a sine qua non in order to invoke section 68. But if books of accounts are not there, and then the assessing officer invokes section 68, can it be corrected by CIT appeal or not? Yes, of course. CIT appeal has got coterminous power with that of the assessing officer. Then one of my friends asked me yesterday, sir, he can confirm, he can enhance, he can annul, but then how can he change the section? No, if he is confirming the addition, he is confirming the addition not under this head, not under this section, but some other head or some other section. So merely because he happens to change the section, that to the correct section, then you cannot be heard saying that this is outside the power of confirming the addition. No, this is part of the confirmation. This is part of the. So CIT appeals powers are very wide. Though of late, some kind of restrictions sought to be read. But anyway, the scope of the topic is not this. So, but if the tribunal wants to change the section, if at all the tribunal can do or not, that is a question. I remember tribunal itself in 71 ITD at page 324 in the case of Jawaharlal Oswal. The tribunal said the considerations between section 68 and 69 are different, and therefore the tribunal, which is an independent judicial body, now cannot be seen to be siding either of the parties. So if a wrong section has been invoked, it is merely invoking the wrong section or assuming the jurisdiction under the wrong section. Whether 292B can be invoked to correct it, that is also a question to be examined. But Allahabad High Court put it foots down in Sarika Jain's case, that this is none of the business of the tribunal to make the assessment which was made under section 68 to section 69 or 69A or 69B. So any sum which is found credited in the books of account of an assessee and the assessee does not offer an explanation. So if assessee does not offer an explanation, obviously he would do it at his own peril. Then obviously the assessing officer would not have any other option but to treat it as undisclosed income of the person. So if an assessee does not offer any explanation as to the nature and source, and the explanation offered by him is not to the satisfaction of the assessing officer, then in such a situation, the amount credited in the books of account would constitute income from undisclosed source of that previous year. And that too, assessing officer may treat it. Explanation not to the satisfaction of the assessing officer. Assessing officer, though, is the ultimate arbiter for the purpose of adjudication under section 68, but then his satisfaction is not the end of the road. His dissatisfaction, obviously when he will be dissatisfied with the explanation, in that situation then he may treat this credit as the income of the assessee of that year. So his dissatisfaction is not the end of the road. His dissatisfaction is subject to judicial review before the higher appellate firm. And though the legislature has used the expressions may, the expression may has been used that after eliciting, soliciting the reply from the assessee as to the nature and source, then the assessing officer, in his quasi-judicial capacity, in his capacity as an adjudicator, now would ponder over that reply and then would act judicially. That is why the legislature has used the expressions may. But courts have said that even if we use the expressions may, even if the legislature uses the expressions may, but if the conditions do exist in any given case which should compel a judicial authority to take a final and definite stand, then there is no option with that adjudicating authority to take any different stand. So depending upon the facts of a case, the assessing officer, even if the legislature has used the expressions may, now shall exercise that jurisdiction in that manner. Because may suggests that the discretion is though vested, but then this discretion is the judicial discretion. It is not an arbitrary discretion. It is not a discretion to be exercised at mere whim and fancy of that adjudicating authority. He has to give reasons. He may not directly conclude, but then he will have to spell out the reasons leading to that conclusion. I always say that though conclusions are important, but then the process of reaching to that conclusion is equally important. And that is one of the principles of natural justice. That every order passed by a judicial, quasi-judicial or administrative authority have to be speaking order. Speaking in terms of the reasons, because tomorrow his decision will be called in question before the higher court. And if there are no reasons, then how would higher courts apply its mind as to what had gone into the mind of the adjudicating authority before he reached to a conclusion? That is why it is treated as one of the principle of natural justice. So legislature though has used the expressions may, but then nature and source explained by an assessee, if does not come to the satisfaction of an assessing officer, then he will have to spell out the reasons, and those reasons will be subject to the review jurisdiction or the appellate jurisdictions before the higher appellate or the revisional authority, or before the writ court, depending upon the remedy one has gone in for. Addition has to be in the year of credit. Because it says some credited in the books of account. It will be treated as a, but then at times you will find that this credit can be traced back to an earlier year. After all, the taxability has to be brought in a particular year, section 5, which defines the scope of the total income of a year. So section 68 though says any sum found credited will be deemed to be the of that previous year. But if the source of that credit goes back, and it so happens, particularly in respect of those credits which are made at the beginning of the financial year. I remember 140 ITR 880, 140 ITR 880 Delhi High Court had a very interesting occasion to examine this. The High Court said, we will see in which year that credit has surfaced for the first time. I remember I had an occasion to argue a matter before the Delhi bench of the tribunal, where though the credit was made on 3rd of April, but when we went back, we found that amount had surfaced on 29th of March. Entry was made in this year, credit was made in this year. Taking the cue from this judicial decision 140 ITR 880, the court was constrained, though ostensibly and apparently, and to begin with, the court was not with me. But then, when there was the jurisdictional high court decision, that the year in which that amount has surfaced for the first time, so that aspect needs to be taken care of. In source of the source, right from Assessee 49 ITR 273 used to be the landmark decision. After Daulat Rai Rawatmal 87 ITR 349. But then source of the source principle has been diluted in case of the share capital particularly. From assessment year 2013-14 when a proviso has been added to section 68. That in case of the share capital, the source of the source will have to be proved. The person in whose name that credit stands now will also be required to explain as to what is the source in his hands. Only then the onus can be said to be discharged. And section 68 casts the onus on the shoulders of the assessee. Though this is the cardinal general rule of taxability that if something which is apparently not income but is sought to be taxed as income, the burden to prove that this is income should ordinarily be on the person who alleges. So in case of the taxation, since the income tax officer will allege, therefore the burden should ordinarily rest on his shoulders. But then when the fiction has been created under section 68, the onus has been cast that the moment there is a credit in the books of account, the nature and source will have to be explained by an assessee. And that is called the discharge of onus by the assessee. The onus is something different from the burden, though both terms are loosely expressed. Burden is fixed, onus is oscillating, vacillating, like a pendulum of a watch. So, I discharge my onus is equivalent to that the ball is in my court, I hit it back. The ball has gone into the court of the opponent. Now he will discharge the onus. He will hit it back to me. And that is how the onus keeps on shifting from one end to another. Extent of onus, though the section doesn't say, but then the judge made law, the judge also interpret the law. The extent of onus may depend upon the nature of credit. Now, if some credit has become yours, that too forever, the kind and the extent of onus in that situation would obviously be different. Now, if you have received a gift, meaning thereby that you have become the absolute owner, and then take another situation whereby you borrowed and then you repaid it, that too along with the interest. In this situation, the extent of onus. And third situation, where you made some purchases in the ordinary course of the business, you paid the creditor. When the assessment was being done, you were not having any dealing with that creditor. The onus in respect of that creditor, the extent of the onus would vary, would be different. You cannot say in this third category of credit that you have to prove identity, capacity, and the genuineness. So, though if we go by plain reading, then it doesn't come out. But then the courts do tend to take a view that the onus cannot be uniform in all types of credit. That depends upon the facts and circumstances. That is why I always say whether a credit appearing in your books of account is genuine or not is a question of fact, not a question of. And that is why when my friends rush towards the judicial decision of case law, I always say hold back. You have to see whether the question which you are going to address is a question of fact or a question of law. When something has to be proved with the help of evidences, whether this is genuine or not, now no amount of judicial decisions will come to your rescue. My very good friend, Mr. Murli from Hyderabad, who is listening it, he wrote me a couple of days back after hearing me. His father was the president of the Income Tax Appellate Tribunal, Krishna Murthy sir. That you have to prove with the evidence. Case laws are not judicial decisions. Judicial decisions are not the evidence. Section 69, 69A, 69B. Section 69, almost identically worded. When in a financial year, Assessee has made an investment, and Assessee does not offer any explanation as to its nature and source, or the explanation offered by the Assessee is not to the satisfaction of the assessing officer, then such investment will be deemed to be the income of that previous year. So if an Assessee has made investment, but then who has to prove? There the initial onus in section 68 was on the shoulders of the Assessee. Under section 69, Assessee has made investment. Department will have to prove. The assessing officer will have to prove it. Sir, here is the evidence. Assessee has made investment. Or alternatively, Assessee accepts that he has made investment. That is a different matter. Then that fact that he made investment stands established by the admitted facts. But the burden to prove that the Assessee has made investment in any asset rests on the shoulders of the assessing officer. And rest is the same, does not offer an explanation. Then obviously he doesn't offer an explanation. Then what else can assessing officer do except to treat it as investment from undisclosed source? Or if he explains, but then this explanation as to the nature and source of that investment is not to the satisfaction, the same principle. The satisfaction of the assessing officer is subject to judicial review. Dissatisfaction of the assessing officer is subject to judicial review. And in any case, before he is satisfied or dissatisfied, then his decision has to be based on objective considerations. Objective considerations. He cannot be permitted in law to take an arbitrary decision. It has to be based on objective consideration. And in case Assessee is not able to offer an explanation to the satisfaction of the assessing officer, then there is a fiction which determines the year of taxability. There is a fiction that when that investment is found to have been made in this year, then this will be the year. But then this presumption is rebuttable. It's not irrebuttable that under all circumstances, this will be treated as income of this year. But then fiction is there. But when fiction is there, presumption is there, and you want to operate against that presumption as an Assessee, you want to say, no, sir, it is not the income of this year. This is the income of that year. Then the burden is on you to prove it because you want to swim against the tide of presumption. So if you want to say, sir, this locker was not operated since last 3 years. Therefore, the jewelry which has been found today, when you conducted the search, maybe you may have discovered it today. But then with the help of this fact, and which is proved with the help of the banking records, that this locker has not been in operation for the last 3 years. Therefore, if at all, this is undisclosed investment, at least it is not the investment of this year. It is traced back to the 3rd year when it was last operated. Because from that date till this date, there was never an occasion to replenish or to take out the items which are there in this locker. So, burden in such a situation would be on yours. In the matter of section 69, you may have come across with certain instances where the agriculturists who sell their agricultural land, that too situated in the rural area. When I say rural area, means the agricultural land located in those areas do not constitute capital asset, and therefore if there is surplus on the sale of such agricultural land, then that is not taxable. So these rural agriculturists, they do not know the implications of tax law, but the buyer who is buying the agricultural land from them, now he pays them on money and gets these properties registered at lesser stamp duty value. And these agriculturists deposit the amount in their bank account. Now, when the AIR information goes to the assessing officer that huge amount of cash has come to be deposited in the bank account of such and such person, then appropriate remedial measures are sought to be initiated by the department. Those agriculturists Assessee do say, and though it is a fact, but then the fact has to be the established fact. So they sold land, they got this money is over and above the money which was paid to us through the banking channel. But since it was the sale proceeds of our agricultural land on which there was no tax payable, we deposited in the bank account. And sir, kindly see the land, we have sold it, and this amount has been deposited near to that only. These agriculturists Assessee in such circumstances have got a very tough time, because the tax authorities would not accept it. They would say, your registered documents show this much, which was received by you through banking channel. Therefore, we cannot ascribe this cash deposited by you in the bank account to the sale of this rural agricultural land. This may be your own income from undisclosed source which has been deposited in the bank account. Problems to come, because you have been found to have made investment in the bank account. You have to offer the explanation as to the nature and source. Though you offered explanation as to the nature and source, but then explanation is not supported with evidence. One circumstantial evidence is there in your favor, but then equally or rather more weighty evidence is there in the form of those registered documents which say otherwise. But then it depends upon the facts and circumstances. How do you plead it? I remember in one of the cases, I asked the son, who was minor, approaching the majority, are you aware that your father has sold this property? He said no. And if you don't know and your father has sold it, then why don't you challenge the very factum of the sale of this property and get this sale annulled? The suit was filed in the court. That brought the developer to the negotiating table. Because after all, the fact, the truth has got a lot of force, moral force. Anyway, so it depends upon the facts and circumstances. I do not, at this stage, I do not want to go into the specifics. I just wanted to give certain dimensions. Section 69C, section 69, 69A, 69B. 69 speaks of the investment. 69A speaks of the money, bullion, jewelry, valuable article or thing. And section 69B talks of investment and money, bullion, where they are partly recorded in the books of account. And rest of the ingredients of those three sections are identical. Therefore, I am not going on there. 69C, when expenditure has been incurred outside the books. This is different from the bogus expenditure claimed by you, because the bogus expenditure which you claim the source of payment of such bogus expenditure is coming out from the books of account. Whereas I am talking in section 69, he is talking about an expenditure which has been incurred outside the books. The source of which is not there. And again, the language is same when the assessee does not offer its explanation about the source. And then, to the satisfaction of the assessing officer, then the assessing officer in that situation would treat it as an expenditure having been met out of the income from an undisclosed source. There is a proviso which says that even if that expenditure which has been so incurred outside your books of account may be the expenditure relating to your business or can be claimed under any other head of income, but then no deduction will be allowed to you. This was added from 1499. Earlier we used to claim such kind of expenditures also, because when I remember survey took place, some wages having been paid outside the books of accounts are found. It was added under section 69C, but at the same time that we lost our claim. Sir, these are the wages admittedly as per the contemporaneous documents found at the time of survey. Therefore, you kindly allow these expenditures against the business profits. So, from one hand you take, on the other hand then you'll have to give. So back to the square one. But then the legislature became over-indulgent here and then brought out a proviso. But then this kind of a proviso is not there under section 69. So if some on money has been paid and found by the assessing officer, addition has been made, and then that asset comes to be sold at a later stage, then the amount which was paid in A and the amount which was added as on money put together would constitute the cost of acquisition of that asset, because the proviso which is there under section 69C, that is specific to section 69C. There is no corresponding provision to deny the benefit of such kind of on money forming part of the cost of acquisition of that asset. So the benefit of indexation and all you will get it. 69D, the height of fiction, that if you have borrowed, you have paid, you have borrowed, that is also accounted for, you have paid, that is also for accounted for, but then it has been accepted or repaid otherwise than through the banking channel. Under section 68, 69 A, B, C, the source of the money was not explained. Whereas under section 69D, though the applicability to this section is not much, but if you borrow any amount on hundi, otherwise than by an account paycheck or bank draft, then that will constitute your income. Even if the source of that amount which you have borrowed is explained, or if you have repaid any amount of hundi otherwise than by an account paycheck, then also that will be treated as your income. Even if you show it, sir, it was available in cash in hand, was available in my books. No, nothing, because section 69D now deems such kind of acceptance of any amount on hundi otherwise than through the banking channel, or payment of any amount on hundi otherwise than through the banking channel, the fiction. Now then comes section 115 BBE. 115 BBE, there was a history. It came by Finance Act 2012, but then prior to that also it has a history. There was a Gujarat High Court decision in Fakir Muhammad Haji Hassan, 247 at 290. For the first time, this issue came up before the Gujarat High Court, a very innovative issue, is that these kind of incomes under section 68, 69, 69 A, B, C, they are the orphan sections. Orphan sections, I am using lighter sense. And in section 14 of the Income Tax Act specifies 5 heads of income. Now, since section 14 says save as otherwise provided by this act, therefore the Honorable Gujarat High Court held that there can be some other income which may not fall under those 5 heads, and section 68, 69 ABC are those types of income, and therefore such incomes have to be taxed separately. Then came Kim Pharma, Punjab and Haryana High Court, relying upon Fakir Muhammad Haji Hassan. And when the decisions started pouring in from the High Court, the legislature, the government thought, why don't we legislate this in section? So section 115 BBE was made. Finance Act 2012 with effect from 1/4/2013, that if there is an addition under this section, then you pay us 30%. At that time, 30%. You pay us 30%. Because these are the orphaned section. They will not be allowed any deduction. They will not be allowed any set off. So far as set off is concerned, that day when I was speaking on the black money law, because identical expressions, identical section is there under section 5 of the Black Money Act, I asked a question having a parity from section 115 BBE. What can be the deduction on account of any expenditure or allowance, which can be claimed against section 68, 69, 69A, B, C. Whatever could be claimed in section 69C, that has been denied already by inserting a proviso. At least I had not been able to fathom any item of expenditure or allowance which can be claimed under section 6, which can be claimed against the income of 68, 69A, B, C, which is sought to be denied by mentioning specifically under section 115 BBE2 that no deduction on account of any expenditure or allowance will be allowed. No set off of any loss. It was added later on. No set off of any loss will be allowed against this income. I can understand. There can be interhead adjustments. Had this not been allowed, had this not been debarred under subsection 2 of section 115 BB, then there would have been the possibility that such kind of income would have been set off against the losses some other head, because interhead adjustments permissible. So to that extent, I can understand 115 BBE2, but I have not been able to decipher as to what kind of expenditure or allowance which could have been allowed, which is sought to be disallowed by making an explicit assertion under subsection 2. But anyway, so, but then came Taxation Law Second Amendment Act, which stepped up the tax rate. So that Taxation Law Second Amendment Act came on 15/12/2016. But then it was made operational from 1/4/2017, meaning thereby that it has got the retroactive effect. That even such kind of incomes from 1/4/2016 to 14th December 2016 now would also have to face this tax rate of 60%, even if this tax rate itself was born on 15th of December 2016. So the legislature has sought to overreach. This retroactivity has been challenged before the Rajasthan High Court. I have been told the notice has been issued. Thereafter, because of this pandemic, what worthwhile progress, if at all, has been made, I mean, that is not to my knowledge. Now imagine a person who was surveyed, say in May 2016. At that time, the law was whatever income you would offer, even if this income is under section 68, 69 AB, then it will suffer the tax rate 30%. Then on 15/12/2016, when this Taxation Law Second Amendment Act came, then he came to know, on account of a prospective action on the part of the government, that surrender which he made on 15th of May, now under this ostensible belief that the tax rate would be 30%, now he would have to cuff out the tax rate of 78%. But the legislature, the sovereign power, unless it is constitutionally struck down. Vatika Township Supreme Court says that you cannot fasten the tax liability retrospectively. So it is in the womb of time. it is subject to incisive, it will be subject to incisive judicial scrutiny, as it has been called in question by Rajasthan High Court and maybe called in questions by other High Court. Tax rate of 78%. We have gone back. We have gone back to those times when the tax rates used to be of confiscatory nature. 78%. This kind of a tax rate. And in case of such, imagine, apart from 78%, then the penalty minimum 30%. Under section 271 AAB. So section 115 BBE says, now I am going to discuss something very important. We are racing against time. 115 BBE, now it says that if the total income includes any income referred under section 68, 69 A, B, C, D and included by the assessee in his return or determined by the assessing officer in assessment, that will suffer the tax rate of 60%. Then there is surcharge, 15% effective, and then there is a cess, 3%, 78%. But then only those income from undisclosed source which fall under section 68, 69, 69 ABC. There may be undisclosed income, but not all undisclosed income has to suffer the tax rate of 78%. That is what I wanted to drive home. So the distinction of income from undisclosed source and undisclosed income from the definite source. They are two different, distinct and independent things. You have to bear in mind. Income from undisclosed source. Income from undisclosed source has to be assessed under section 68, 69 ABC invariably. And therefore section 115 BB is there to embrace it. The tax rate of 78% keeps on staring at the face of the taxpayer when there is an addition on account of undisclosed income from undisclosed source. But there may be undisclosed income also, but not all undisclosed income is assessable under section 68, 69. An employer was surveyed and the evidences were found that the hefty bonuses had been paid to CEO or to some key person and which were kept outside the books of it. So in the hands of that employer, this amount will be added under section 69C because it will be treated to have been paid out of books from the income from undisclosed source. And therefore 115 BBE stepped up high tax rate will take care of it. But the bonus received by an employee, you forget about 269 ST for the time being. But this bonus in the hands of the employee, even if it was not disclosed by him, even if his employer has paid it outside the books of account, will constitute income under that salary. And when it will constitute income under that salary, it will suffer the tax, 30%. Some tenant paid the arrears of rent to the landlord outside the books of account. For him, if he is carrying on business or even if he is not carrying on in business, this payment which has been made by him outside the books of account will constitute income from undisclosed source, which can be assessed under section 68, 69 ABC, whatever. I'm loosely calling it. Can be taxed under section 69C, of course. Therefore, when it is to be taxed under section 69C, then section 115 BBE there. But then this arrears of rent received by the landlord now would be assessed under the head income house property. Even if it is undisclosed, but it will suffer the tax rate of 30% or whatever applicable rate with all concessions of statutory deductions, if at all this is available under the scheme of income under that house property. An owner of a property who sold the property for a consideration and he received on money. That person who has paid on money outside the books of account would have to pay tax at the rate of 78% in respect of the on money paid by him outside the books of account. But then this person who has received this amount, even if he has not disclosed it, but then the nature of this income is income from the capital gain, and therefore whatever tax rate is applicable, whatever deductions or exemptions which can be availed, which are available subject to the fulfillment of the conditions of section, that he is entitled to have it. So again, I would emphasize income from undisclosed source and undisclosed income from a disclosed source. There are two different, distinct and independent. And why I'm saying, showing, demonstrating, speaking, emphasizing is a purpose. That purpose I am coming very quickly. Because one of the things which, if you remember in the questions, we threw, I and Somil drafted the questions, was that how can we navigate between the tax rate of 30% or 78%? Because 115 BBE, 78% tax rate is there. But then during the course of survey or search, when the surrenders are made, now, is there any scope to navigate from 78% to 30%? That is the question, which was the last question which was put by us. There is a survey or search for that matter in case of business establishment. Hardcore evidences are found which suggest the sale of the continuing business or from some other business which has been totally kept outside the books of account. Now, income from this business or income from a new business which was discovered as a result of survey or search may be undisclosed income, but then this undisclosed income from a definite source, that is income under that business. And therefore, it would suffer because the contemporaneous evidences were found during the course of survey or search in the form of cash memos, in the form of sale invoices, in the form of other contemporary records. So on facts, evidences were found. Then in that situation, undisclosed income, even if it's undisclosed income, but this is not income from undisclosed. Similarly, some expenses have been found to have been inflated and thereby depressing your business profit. Now this attempt to depress the profits gets exposed. Then what would happen? Your income under that business would increase. Even if you have suppressed your business income, meaning thereby that there was an undisclosed income, but that this undisclosed income has got the definite source, that is the business income. It was not income from undisclosed source, therefore there was no question of section 115 BBE coming. Now take converse. Now take the reverse. That merely because you are offering some income in your books of account under a particular head, as I said when I discussed section 68, that the true character of an income is required to be determined by the assessing officer. It is his bounden duty. He owes a legal duty while discharging his quasi-judicial function. So you showed it, like in case of the penny stock, you showed it as if this is the sale proceeds of the listed equity shares. But then when he exposed it, the real character of this transaction got exposed. Now though you have disclosed it in the books of account, now merely because you disclosed it in the books of account, but then the real character of this transactions got exposed with the help of evidences, of course. Now this disclosure of income from some supposedly disclosed source, now all of a sudden has become income from undisclosed source to be taxed under section 69, and we have seen a good number of cases. So merely because you are showing something in your books of account, it does not give you a license. It does not give you a blanket license to say, no, since we have disclosed it, therefore the normal tax rate. It converts situation. Like during the course of demonetization, if somebody has shown, though on facts they were really sales, but suppose if you have shown sales and then offered the income under the business, but then the assessing officer is not sale, though that is a subject matter of judicial review with higher appellate forum, but then merely because you declare something, therefore, now I come to the final point, it is already 7:20. When the survey or search takes place, if the surrender is made in some investment, that investment may be cash, that investment may be stocks, that investment may be building, that investment may be, if declaration of additional income is made in investment, in assets, then there is every possibility of such surrendered income being taxed as income from undisclosed source with stepped up higher tax rate of 78%. But if the income is offered as income, which is assessable under a particular head of income, suppose there are unmoved creditors. Now that is surrendered. 41 subsection 1 is that is income under that business. That will not be income from undisclosed source. If there are surrender of some profits on account of the higher gross profit rate or the net profit rate, whatever profit would come, that would be income from business. Some bad debts were claimed. Now those bad debts have recovered. I mean, you recovered the bad debts. Those bad debts which you happen to recover would be taxable under section 41 subsection 4 under that business. If there were certain inflation of expenses, now you surrender on account of those inflation, then your business profits would fail. That will be income from business. Some sales were suppressed and that suppressed sales is surrendered. Shortage of stock found. Then the presumption is the sales have been made outside the books of account. Then the sales which have been made outside the books of account, obviously your business sales. So surrender of income and surrender of asset, the tussle is like this. But then somebody can say, sir, during the course of survey of asset, in fact, the asset is found. So when the asset is found, obviously the investment has to be surrendered. But then if you make surrender of income and you are able to connect that income with that asset, then of course the telescoping will be allowed, will have to be allowed. So the objective of today's discussion, I cannot offer any blanket prescriptions towards the facts and circumstances of each case. Now I have tried to deal and dwell. Now all these questions which we framed, they were framed by Somil very ably. And therefore, the topic which we kept deemed incomes, deemed. And obviously, if these kind of deemed incomes, the tax liabilities are fastened on the head of the taxpayer, though our Prime Minister today gave salute to the honest taxpayers. But sometimes there is disconnect. Anyway, it's good. Whatever comes, we should accept with both hands. So, deemed and doomed. And I tell you, when one of my chartered accountants friend today morning, Rakesh ji, doomed is not appropriate expressions. Maybe it may not be appropriate expressions. But then I have seen at least 2 cases where that Assessee started saying, sir, I am going to commit suicide because of these kind of assessments which have been made on me. And one of them was my chartered accountant friend. So when such kind of incomes, such kind of assessments are made, that too on the basis of deeming fictions, there cannot be any better expressions than using the expression of the doomed assessees. And that backdrop, we use that expression. So friends, thank you. It's almost 2 hours. If there are questions, then we can take questions. And questions, how should I take?
Sir, we can take from YouTube if you can see there.
I will have to take. Okay, skip trial. Yaar, kya ho raha hai? CASA deemed. Just a minute, please. I am seeing it because what is more important is the questions. If I can. Deemed income. Yes. Ah, so the questions, it is working. Team Casa, copy paste, provide link. Please provide link. Very
NK
nice
Gupta.
webinar. Nice webinar. NK Gupta and Company. The first question:
Ji.
whether Section 115 BBE can be attracted in case of a cooperative housing society which claimed its income exempted, but the AO denied the exemption and assessed the income under Section 143. Gupta sahab, merely because that he has denied the exemptions, therefore the income would become chargeable under Section 115 BBE. The law is not like this. Even if the exemption has been denied, then the income has to be assessed under some head. Because if it is found that cooperative society is carrying on business or carrying on some activity with the income of which should be assessed under that other sources, so there is no question of assessing or charging the tax under Section 115 BB in this case. Now, all that on which 115 BB can be brought is the income which is assessed under Section 68, 69, 69 ABC. And I believe from your questions and the background of the cooperative society, there will not be any income which may have been taxed under Section 68, 69, 69A. Ajay Agarwal ji kya keh rahe hain? Sir, what is the difference in books used in Section 68 and books of account used in Section 69? No, there is no difference. It's one and the same. चुक साहब हमारे बड़े प्यारे दोस्त हैं फरीदाबाद से. A loan is received by check on 30/3/2012. Check deposited returned unpaid due to reason other than insufficiency of funds. Represented on 3/4/2012. In which year it will be said to have surfaced? Obviously, on the first occasion, 30/3/2012. 140 ITR 880. Good evening, all of you. PPT will be shared. I speak extempore. So there is no PPT with me.
Satyanarayan Murthy, sir.
Just a minute. Joravar Singh Bhasin. How valid? ये Bhasin साहब मेरे बड़े प्यारे दोस्त हैं. And he follows me very closely. Okay. How valid is it to treat deemed income as escaped income for Section 147? It's perfectly valid. Now, if there is some income which is deemed income under the provisions of law, and there is material for an assessing officer to form the reason to believe that the income chargeable to tax as escaped assessment, deemed income is also chargeable to tax and can escape assessment. Satyanarayan Murthy sir, with respect to 222E, when the registered shareholder has not received the advance, the company has received the advance, can the shareholder be taxed? That is a dichotomy. In fact, I remember when I argued that Anki tax decision, in fact, we lawyers sometimes become too focused on the point which is involved in their appeal. Otherwise, when we argued this case, since this kind of an argument was coming out from 222E and that suited us, therefore, otherwise, I mean, a shareholder of 12% now is made to pay tax in respect of the loan enjoyed by some concern. He has got 20%. Let us assume that he has got 21% there also. And here 10%, there 21%, 20%, minority stake somewhere, but then he has to pay tax in respect of the loan enjoyed by that company. Now, this is something which is very atrocious in 222E. Tarun Malik ji, in case the property is sold to the erstwhile tenant to buy peace of mind much below the circle rate, how to record such a transaction without attracting penalty, not penalty, deemed income under Section 50C and 56(2)(10). Now, you can always demonstrate to the assessing officer, and the assessing officer would have to appoint a district valuation officer. And then you can satisfy the district valuation officer with the help of the background of this property, showing the litigations, the nature of litigations, the period of litigations with the tenant, that in such a situation, the fair market value was the real value. It may be lesser than the stamp duty value. I mean, it depends upon the facts, you can prove it. Sunil Gupta ji, whether Section 56(2)(7)(b) applicable on shares issued on right issue to the existing shareholders and also to the other if right renunciated by the existing shareholder to right offered. Sunil ji, I'll have to check out whether This will be applicable because the language which has been used in the section, when consideration received on the issue of shares. So insofar as the language is concerned, it doesn't make any distinction between the right or between the original shares. So going by the rule of literal constructions, then it has to be interpreted. So even if you are issuing, suppose even if you are issuing the right shares, and right shares you are issuing at a premium, and that premium is more than the fair market value, and such excess if then has been treated by the legislature by creating this kind of fiction as income under section 56 to 7b, then why should it not be taxed? Murthy sir, can we contend that employees' contributions has been paid before the due date under section 139(1), and also prove that the amount received has not been used by the assessee? Murthy sir, probably you are in Hyderabad, so Andhra Pradesh High Court, I think, is not against this proposition, and therefore you can take the help of Allahabad High Court. What was the name? Somil? Shagun Enterprises?
Yes, sir.
Shagun Enterprises. Is it reported, or you can get it in Google?
I'll just check it and give you.
Okay, Shagun Enterprises is the decision Allahabad High Court. Then AMIL Limited, AIIMIL AMIL Limited is a Delhi High Court. I had an occasion to argue there was employees' contributions. And I can send you even the petitions copy which shows the underlying orders containing the factum of the employees' contributions. Even that Aloma Extrusions, Supreme Court, which I had an occasion to argue as one of the batch cases representing the DTDC Korea, there also the employees' contributions were there, but then the Supreme Court remained on that larger issue whether the amendment which has been made in section 43B can be said to have the retrospective effect or not. सागर जी का क्वेश्चन बड़ा अच्छा है. Since it is allowable as business expenditure, keyman insurance premium, then what was the need? Because then obviously when keyman insurance premium, keyman insurance policy amount would be received by that company, then that is taxable. But keyman insurance amount received by that keyman in his hand, it would have been exempt. Therefore, in order to bring to tax, this kind of an amendment was required to be made. I think there are no other questions.
Sir, in the bottom, few questions are there in the bottom.
और भी आ गए हैं. तो मैं विष्णु कनेरे सर, whether 50C applies to TDR, there are judicial decisions to this effect, and it is not applicable to TDR. It is not land and building. This is right in the land and building. Krishnan Gopal ji कह रहे हैं where search is initiated, then no provision of section 68, 69. Where search is initiated, then no provision of section 68, 69A. Now what does it mean? Now 68, 69A, I mean, is not dependent upon the search action or survey action. It is there even in regular assessment. It can be there in search assessment. The ingredients of those sections have to be fulfilled in respect of credit or in respect of an investment. Samadhan S. Sir, what we do when we actually purchase, what we do when actual purchase price is much less than the circle rate. Okay. So under section 56 to 10 as the purchaser, now the differential will constitute it. So if it is low, then there must be some reason for it. So if those reasons, you can prove that these reasons have got bearing on the fair market value, and this is the fair market value on which you have purchased it, then you can prove it. Pankaj Maheshwari ji, person purchased a land for his 5 lakhs, stamp value is 6.5 lakh. He declared 1.5 lakhs deemed income. After 1 year, he sold land for 7 lakhs. What will be the cost of land? Obviously 6.5 lakh. Sir, as usually you brilliantly explained, Juneja Lagaro, कि हमारे दोस्त हैं ये तो समाज प्रॉपर्टी परचेज बिलो सर्किल रेट ये हो गया, बस हो गया फिर तो सारा.
जी सर, जी सर.
तो ज्यादा क्वेश्चन नहीं रहे.
जी.
अनिल कुमार जी, वेरी नाइस डेलिबरेशन. बाकी तो सब तारीफ है.
So you have explained very well. So I think.
Thank you.
Sir, that is Sagun Foundry 78 taxman.com 47.
मूर्ति सर आप नोट कर लें, दोबारा बोलो बेटा.
78 taxman.com 47 Allahabad High Court Sagun Foundry Private Limited.
And there is employees contributions also.
Yes.
Okay.
Yes.
So thank you very much, sir, for your wonderful deliberation, and Somil sir also thank you very much. So it is time to present a certificate of appreciation from my side. Team
Okay.
Kasa side.
E-certificate.
Just sir,
E-certificate,
certificate. Certificate, sir. Sir, this is for you, sir.
Thank you. Thank you.
And this is for Somil to you.
Thank
And
you.
Okay.
Sumit.
Thank you. Very
And
good.
sir, on the eve of CA Day, happy CA Day.
Happy CA
And
Day.
happy CA Day
CA
to
Day.
all the members present over here. और
Thank you
सर
very much
बहुत ही
to
wonderful
all viewers.
deliberation मिला आप लोगों को.
Thank you. Thank you.
Thank you to all viewers for joining this wonderful
Thank you.
deliberation. Thank you, sir.
Thank you.